You can own 100 stocks and still not be diversified. You can even add a highly volatile asset and make your entire portfolio safer. Both statements sound impossible until you understand correlation. In this lecture, we reveal why diversification isn't about how many investments you own, but about how the risks hidden inside them move together. We are going to study diversification, portfolio risk, and portfolio return. This topic is one of the foundations of investments. In real life, investors rarely hold only a single risky asset. They usually hold portfolios made up of stocks, bonds, funds, cash, and other assets. So the important question isn't only, is this asset attractive? The better question is, how does this asset affect the total portfolio? That distinction is very important. A portfolio isn't simply a collection of securities. It is a collection of exposures. Each asset receives a weight, and those weights determine the portfolio's expected return, volatility, sensitivity to market conditions, and exposure to different sources of risk. Portfolio return is relatively straightforward. It is based on the weighted average of the returns of the assets in the portfolio. Portfolio risk is more interesting. It depends not only on how risky each asset is individually, but also on how the assets move together. This is the heart of diversification. Sometimes, adding a risky asset can reduce total portfolio risk if that asset behaves differently from what we already own. So in this lecture, we will build the intuition step by step. Weights, expected return, risk, covariance, correlation, diversification, and the connection to modern portfolio theory. Let's begin with portfolio weights. A portfolio weight is the fraction of total portfolio value invested in a particular asset. If you invest part of the portfolio in a stock fund, part in a bond fund, and part in cash, each part has a weight. In a fully invested long-only portfolio, all the weights together represent the entire portfolio. Long-only means we aren't borrowing, not using leverage, and not taking short positions. Each position is positive, and the portfolio is fully allocated across the assets. Why are weights so important? Because weights translate investment choices into portfolio behavior. Two investors may hold the same securities, but if their weights are different, their portfolios can have very different expected returns and very different risks. A large weight in an asset means that asset has a stronger influence on the total portfolio. A small weight means the asset has less influence. Some portfolios allow short selling, borrowing, or leverage. In those cases, weights require more careful interpretation. A short position can have a negative weight, and leverage can create weights that exceed the value of the original capital. But for introductory portfolio construction, it is helpful to start with long-only portfolios. The key idea is simple. Portfolio construction begins with allocation. The assets matter, but the weights determine how much each asset matters. Now let's discuss portfolio return. The realized return on a portfolio is the weighted average of the realized returns of the assets in the portfolio. The expected return works the same way. It is the weighted average of the expected returns of the assets. Each asset contributes to portfolio return according to its weight. If an asset has a larger weight, its return has a larger impact on the portfolio. If an asset has a smaller weight, its return has a smaller impact. This is why expected return is called linear in portfolio weights. The expected return of the portfolio changes directly with the weights and the expected returns of the assets. Notice something important. Expected return doesn't directly depend on covariance or correlation. Covariance and correlation become essential when we measure risk, not when we calculate expected return. Also, expected return isn't a promise. It isn't a guaranteed outcome. It is an estimate based on assumptions, probabilities, historical information, forward-looking analysis, or a model. So when we say a portfolio has an expected return, we mean this is the average outcome we expect under our assumptions. Actual returns may be higher or lower. That is why investment management always requires both return analysis and risk analysis. Let's turn to portfolio risk. In investments, Risk is often measured by variance or standard deviation of returns. Variance measures how much returns tend to deviate from their expected value. Standard deviation is the square root of variance, and it is usually easier to interpret because it is expressed in return units. For a single asset, risk is about how much that asset's return fluctuates around its expected return. For a portfolio, risk is about how much the total portfolio return fluctuates around its expected return. A common mistake is to think that portfolio risk is just the weighted average of individual asset risks. That is generally not correct. Expected return is a weighted average. Portfolio risk isn't usually a simple weighted average. Why not? Because assets interact with each other. If all assets tend to rise and fall together, combining them may not reduce risk very much. But if some assets perform differently under different conditions, their movements may offset each other. The total portfolio may become more stable than the individual assets suggest. So the important question isn't only how volatile is each asset, it is also when does each asset become volatile and do the assets experience gains and losses at the same time? This is where covariance and correlation enter the discussion. Covariance measures how two asset returns move together. You will see the covariance formula on the screen, but let's focus on the meaning. If two assets have positive covariance, they tend to move in the same direction relative to their expected returns. When one performs better than expected, the other also tends to perform better than expected. When one performs worse than expected, the other also tends to perform worse than expected. If two assets have negative covariance, they tend to move in opposite directions relative to expectations. One asset's positive surprise may be associated with the other asset's negative surprise. If covariance is near zero, the assets don't have a strong linear tendency to move together. Covariance matters because portfolio risk depends on interaction. Two risky assets may create a less risky portfolio if their returns don't move together strongly. That is the economic power of diversification. However, covariance can be difficult to interpret directly because it is measured in squared return units. This makes the number less intuitive. That is why we often use correlation. Correlation is a standardized version of covariance. It tells us the strength and direction of co-movement in a way that is easier to understand. Covariance gives us the raw co-movement. Correlation gives us the same idea in a standardized language. Correlation is one of the most useful concepts in portfolio management. Correlation tells us how strongly two assets move together in a linear way. It doesn't tell us that the assets have the same expected return. It doesn't tell us that they have the same volatility. It tells us how their deviations from expected return tend to move together. When correlation is strongly positive, the assets tend to move together. This usually reduces the diversification benefit. When correlation is lower, the assets move together less strongly. This usually increases the diversification benefit. When correlation is negative, the assets tend to move in opposite directions. This can create a strong stabilizing effect in the portfolio. For a portfolio with two risky assets, the variance expression shown on the screen has an important structure. Part of the formula captures each asset's own risk. Another part captures co-movement between the assets. That co-movement term is the reason portfolio risk isn't usually a simple weighted average of individual risks. Holding weights and individual volatilities constant, lower correlation reduces portfolio variance. Higher correlation increases it. This gives us a major lesson. Diversification isn't just about holding more securities. It is about holding securities that don't move together perfectly. The quality of diversification depends on the relationships among the assets. Now, let's connect correlation directly to diversification benefits. Diversification works because imperfectly correlated assets don't move together perfectly. When one asset has an unexpectedly poor return, another asset may have an average return, a less poor return, or even a strong return. These offsetting movements can reduce the volatility of the total portfolio. If assets move together perfectly, diversification provides little risk reduction relative to the weighted average of individual risks. In that case, the portfolio behaves like a bundle of assets all responding in the same way. If correlation is less than perfect, diversification begins to help. The assets aren't identical in their movements, so the portfolio can become more stable. If assets move in exactly opposite directions, the risk reduction can be very strong under the right conditions. In practice, perfect negative correlation is uncommon across broad risky assets. The practical lesson is clear. Lower correlation improves diversification, while higher correlation reduces it. This is why portfolio managers look beyond labels. Two investments may have different names, different industries, or different countries, yet still respond to the same underlying forces. True diversification requires understanding common drivers, not just counting the number of holdings. A portfolio can look diversified on the surface, while still being concentrated in the same risk exposures. Now, let's move from a small portfolio to a portfolio with many assets. When a portfolio contains many risky assets, portfolio variance depends on all the individual variances and all the covariances among asset returns. You will see the full expression in the background visual. The idea is simple but powerful. Some terms measure each asset's own risk. Other terms measure how pairs of assets move together. As the number of assets grows, the covariance structure becomes increasingly important. The covariance matrix becomes central to portfolio construction because it summarizes how uncertainty interacts across the assets. Expected returns tell us what the investor hopes to earn. Variances and standard deviations tell us how uncertain individual asset returns are. Covariances and correlations tell us how those uncertainties combine inside the portfolio. Diversification reduces some risk because asset-specific surprises can offset each other. A product failure, management change, lawsuit, or disappointing project may hurt one company, but it may not directly hurt many other companies. By holding many reasonably distinct positions, the investor reduces dependence on any single company-specific outcome. But diversification doesn't remove all risk. As the portfolio becomes broader, individual asset shocks become less important, while common co-movement becomes more important. That is why covariance remains at the center of portfolio risk, even in very diversified portfolios. This brings us to an important distinction: diversifiable risk versus systematic risk. Total risk can be separated conceptually into diversifiable risk and systematic risk. Diversifiable risk is also called idiosyncratic risk, unique risk, or unsystematic risk. It is specific to a particular firm, security, industry segment, or small group of securities. Examples include a firm-specific lawsuit, a product recall, an executive resignation, or a project failure. This kind of risk can be reduced through diversification because firm-specific surprises aren't perfectly correlated across all assets. Systematic risk is different. Systematic risk is linked to broad forces that affect many assets at the same time. It is also called market risk or non-diversifiable risk. Examples include recessions, inflation shocks, interest rate changes, financial crises, and broad shifts in investor risk appetite. Diversification cannot eliminate systematic risk because these common forces can affect many securities together. This is why even a well-diversified portfolio can lose value during a broad market decline. That isn't a failure of diversification. It is evidence that systematic risk remains. This distinction is very important for asset pricing. If investors can diversify away firm-specific risk at relatively low cost, then expected return models often focus on the systematic risk that remains in diversified portfolios. Diversification reduces unnecessary risk. It doesn't remove the risk of investing. Let's finish by connecting these ideas to portfolio construction and modern portfolio theory. Portfolio construction can be viewed as risk budgeting. The investor chooses weights that balance expected return, volatility, diversification, liquidity needs, investment horizon, constraints, and tolerance for losses. A portfolio manager should ask, which assets contribute most to total volatility? Which positions add exposure to common risk factors? Which positions reduce risk because they move differently from existing holdings? Is the portfolio diversified across true sources of risk or only across many names? The goal isn't always to minimize risk. Investors often accept risk in order to pursue expected return. The goal is to take risk deliberately, understand where it comes from, and avoid risk that doesn't provide sufficient expected compensation. Modern portfolio theory builds directly on this logic. It studies how investors can choose portfolios using expected returns, variances, covariances, and investment constraints. The key insight is that assets should be evaluated by their contribution to the portfolio, not only by their standalone characteristics. Some portfolios are inefficient because another available portfolio offers a better risk-return trade-off. Efficient portfolios are those that cannot be improved in that way, given the available assets and constraints. This prepares us for the efficient frontier, where we study the best available combinations of risk and expected return. Thank you for joining me today. I'll see you in the next video.